Hey, welcome to all of you who have joined Charts that Define 2025. We're just going to give people a few more seconds to join us. But Josh, do you want to give the executive summary version of what we just discussed, or do you want to keep it to yourself?
Oh, thanks, Sean. Great toss. We were discussing male pattern baldness. Did you know over 166 million men in the United States have AGA, otherwise known as what androgen? I don't know. I, I feel like I need to do more research before I could speak intelligently on this topic.
So anybody who thought that they were joining this webinar to talk about charts that define 2025, we may end up talking about male pattern baldness, but hopefully you'll learn something anyway. But why don't we get started here? I'm thrilled to be joined by the CEO of Ritholtz Wealth Management, my friend Josh Brown. For those of you that are concerned that we are related in any way, we aren't. I only wish I were as good looking and as smart as Josh.
We don't know that for sure.
True, true. We really don't, because the mailman in my neighborhood looked an awful lot like you, Josh. So
God. Oh
yeah,
God.
but I'm sorry, Mom. I did not mean to say that. Hey, so Josh, thanks for being on the show. I have to do a couple housekeeping things, and then we'll get going here. So, um, number one is the contents of this webinar are for educational purposes only and not intended as investment advice, unless it is about male pattern baldness, in which case it's investment advice. If you have any questions on this webinar, please feel free to stick them in the Q&A section, and we will try to get to those. Also, on the YCharts website, there will be a recording of this webinar. And for those of you who are participating on this and registered, we will be sending you a follow-up email with the deck that we are using so that you can use all these slides for your own purposes. So that's it for the housekeeping. Josh, any opening words from you before we dive into things?
I'm very I'm very happy to be here and super excited to mix it up with the YCharts fans that are here with us today. And thank you for having me.
Great, thank you. So listen, our intention here is to show about 10 slides that are good recaps of 2025. I'm going to try to tee up what is visually seen on the slide, and then I'm going to turn it over to my friend to talk a little bit about any insights that he may have. So let's get started. We're going to talk about everything from the Magnificent Seven on and conclude with crypto and everywhere in between. So why don't we start now with the Magnificent Seven, which everybody on this webinar knows are the 1.4%. That's 7 over 500. 7 of the 500 S&P 500 constituents really drive the S&P 500. You can see the performance here in red, 22% return for the Magnificent Seven and 13% return for the other 493. So, Josh, any perspectives? This is a heavily, 30% or 33% of the total returns of the S&P 500 are dictated by 1.4% of the stocks. Thoughts?
Yeah, this is one of the key data points that the pessimists and the bears have been using for almost 10 full years to keep other people from investing. And had you listened to that kind of rhetoric, that first it was the FANG stocks before became the Magnificent Seven stocks. But had you listened to this anti-market concentration hand-wringing over the last 10 years, you would have missed out on one of the all-time greatest bull markets for equities as an asset class of all time. And the problem with that is you can't get those years back. You cannot make up for having missed those gains. And that leaves a lot of people waiting for some gigantic generational reset where the Dow drops from 47,000 back to 20,000 so they can have a do-over. But do-overs of that magnitude are very rare. So There are a lot of people who are upset about that and bitter, and you can hear it dripping from their commentary everywhere they appear, everywhere they tweet. The reality is a couple things. Number one, every bull market in history has always featured some degree of concentration. In the 1950s, it was AT&T and ExxonMobil. We've had bull markets where it was IBM. We've had bull markets where it was steel stocks, energy stocks, telecom, chips, software. There is always a leadership group, and there is always an innovation cycle that accompanies a bull market. This is not new. The degree of concentration is high, but then you have to understand what that means is not necessarily what you think. When ExxonMobil is a huge concentrated winner in a bull market, you could point to that and say it's problematic because it's all oil. In the case of the Mag 7, think about how many different businesses they're in. They, these are collections of massive businesses. I think Google has 11 separate businesses that are each doing more than $1 billion in revenue, or more. You're talking. So when you think about Meta, what business are they in? Like it's advertising, but think about
Mhm.
you're talking about billions of people. When you think about Amazon, how many businesses are they in? All of them ish. So the concentration is not as severe as you've been led to believe. I understand you might like it better to live in a world where the Mag 7 were only 20% of the market or 15%, but you don't get to choose. This is what all of your colleagues in the investing landscape have voted with their dollars are the businesses that are worth being the most heavily invested in. And over
Mhm.
time, if that changes, then the market will change to reflect that. Um,
Mhm.
and the last thing I want to say is this idea that it's like indexing or ETFs that are driving this, then explain the disparity. Explain why Meta is in a 25% drawdown and Apple is at an all-time record high. If it's just ETF money into indexes driving it, then why aren't they both at all-time highs? You can't explain it because it's
Mhm.
a fallacious argument to begin with. And I really feel bad for the people who have been caught up in that. It's been the wrong signal, the wrong thing to focus on. Now, what
Yeah.
happens from here? We had a very short-lived rotation after the market peaked on November 20th. And we had huge rallies in energy and more importantly, healthcare. Those rotations are also a permanent feature of long-term extended bull markets. There are other ways to make money. There are tons of stocks on the new high list right now that have nothing to do with AI. I could rattle off 50 of them without even looking at a screen. So, yes, it's concentrated. No, it's not only a tech market or a Mag 7
Mhm.
market. And there's evidence of that everywhere you look. And stop focusing so much on concentration. It's a money loser.
Yep. I forgot to mention this up front. These slides, will be available to everybody, and they can be used, for if you're an advisor, they can be used in a client meeting. I think the one of the takeaways from this slide that I'd point out is just understand your concentration, and it's a reminder about diversification. And Josh is making a strong argument that it's not as concentrated as it looks here. But the good thing is, you can always get in good conversations with your clients about what their concentrations are or aren't, and are they comfortable with that. So let's move on to the next slide. You mentioned AI. So what is this slide all about? Well, this is saying for the superscalers, all listed on Amazon, Alphabet, Microsoft, Meta, and Oracle, have spent in Q3 about 100 billion in capex. So massive spend in support of this transformative theme called AI. And Josh, I'll turn it over to you. But one of the things I hope maybe you can touch on is, um, at what point in time does Wall Street expect to see returns on these massive capex expenditures that people are making in data centers and AI chips?
So I actually think we're in a situation where the narrative is changing really quickly. And one of the tough aspects of remaining long the market this year and staying upbeat is that we've had these periodic bursts of doubt about whether these massive CapEx spending plans are A, sustainable, B, going to have a payoff, C, going to be profitable. And of course, like we all really can't know for sure. But the thing that we do know is that for most of this year, the large hyperscaler tech platforms were no longer competing on features. They were competing on compute, which is a totally new dimension for Wall Street analysts who follow these companies. And so then the question became, well, how do we differentiate between these different companies that are competing on compute? And I think where things fell out is that people started to have more respect for the alphabet strategy and the approach of being completely vertically integrated from the tip of the spear where the user base, the actual Google users, the people finding Gemini during a Google search, or the people in their Gmail inbox or in the Google Cloud, all the way down to the bottom of the stack to the actual chips and related hardware. And Google has very successfully made the case that they will be the most efficient spenders of capital as a result of that vertical integration, which frankly no one else really can match. Um, on the other end of the spectrum, there's a lot of questions about what Oracle has been doing, what OpenAI has been doing, and what their spending means for shareholders going forward and for the whole theme. Because OpenAI does not have the ability to do any of this vertically. They are reliant upon third-party partnerships with all of the hyperscalers from whom they pay and buy compute. And they also, as this becomes more of a consumer driven technology in the mobile world, in the app world, you're going to see how reliant they become upon the kindness of Google and Apple to allow their technology and their apps to proliferate on devices, which they also don't own. So OpenAI, I think, started the first half of this year as a darling, and every time they announced a partnership with a company, that company's stock, including Oracle, would shoot up 20, 30%. And everybody wanted to be in business with Sam Altman. And every 2 days, they were announcing some new spend commitment, tech partnership, vendor relationship. And that, I think, drove the first half of this year. And then sometime around September, October, that narrative started to shift into, wait a minute, are we sure that this company can actually back up all of this spending they've committed to? And immediately you saw the companies that were reliant on OpenAI's continued spending commitments start to falter relative to others. So you saw that in Oracle. And what makes Oracle interesting is it seems to be ground zero of two different themes right now. A, the sustainability of the CapEx boom. Oracle is like uh, the poster child for a willingness to go into debt to spend money, and B, concerns about the credit markets in general. You can't go an hour watching CNBC without seeing them flash a chart of Oracle's CDS, which is effectively an insurance instrument. People that want to hedge their exposure to Oracle, and that's a weird thing to see: a tech company's debt or a tech company's credit default swaps on the screen. So these have become front and center issues. Tomorrow night is going to be a really big moment um, for uh, for people that are invested in the theme. Oracle reports earnings. There's going to be a lot of questions from analysts about this very topic that I just
Mhm.
explained, and I think the results of how Oracle's answers are taken by the investing community will be very eye-opening as far as whether or not this theme has legs into 26.
Yeah, awesome. And as you mentioned thematic things, and Josh, I want to preempt things because I know you're going to accuse me here of a chart crime. Um, got on here GDP, which is a measure of activity, and also market cap, which is not a measure of activity; it's a measure of value. So we put these together, a bit of a chart crime, but I think the intention was to say, just to show the massive size along this theme, particularly related to Nvidia, where you can see at $4.6 trillion, Nvidia's market cap is greater than the GDP of all countries except for the United States, China, and Germany. So is this all proper? Is this a big bubble, or what more should we know about a picture like this?
All right. If you could redo this chart, because it sounds like you're apologizing for it before we even saw it. If you could redo this chart, what would you do differently?
Well, I'd
I understand what
probably,
you're trying to
yeah,
demonstrate, but
I'd
like
do activity
I'll
versus
give you another crack
activity.
at it.
I would say
Okay.
activity versus activity,
Revenue versus GDP.
revenue versus GDP.
I think I would have either done that, or if you wanted to use Nvidia's market cap and not its revenue, because I get it, like the scale is gigantic. Maybe I would have taken those country stock markets in totality.
Mm-hmm.
That might have been another way to do
Yep.
it, just to show like how much money is like betting on Nvidia relative to like countries, and it's
Yeah.
a crazy. I think that chart would be equally impactful. We're talking
Yep.
about biggest market cap ever for any publicly traded business in our lifetimes. May never see anything like it ever again.
Yep.
I don't know. So
Yeah.
it's
Yep.
notable. I think
First company
Nvidia
to
actually had
four
a
and 5 billion, all within 1 year.
trillion. Yeah,
Trillion. Yeah.
I think Nvidia had a good year, but for the last couple of months it's been stuck in the 180s.
Mm-hmm.
It made a brief attempt above $200 a share and fell off, and it's had trouble getting back. There are some narrative shifts around the Nvidia story that have made it just a little bit tougher. The first is one of the reasons Alphabet has had such a tremendous run is because of the mileage they're getting out of TPUs. These are tensor processing units. These are their own homegrown application specific integrated circuits, or ASICs. Effectively, they are not as broad as a GPU, which is what NVIDIA sells, but they've been built very deliberately to satisfy these very narrow, important use cases. And what Alphabet's been able to demonstrate since the release of Gemini 3 2 weeks ago, which is entirely running on TPU, trained by TPU, is that NVIDIA doesn't have the whole game to itself anymore. Added to that, we saw news that Meta may be pivoting some of its spending toward TPUs from Alphabet, which I think the market looked at that and said, uh-oh, because what we haven't seen Alphabet do is actually sell these chips to third parties. They've allowed third parties to rent usage of
Mm-hmm.
TPUs inside of the Alphabet environment. But this represents something new. And we saw Amazon announce something similar a few weeks before that. So I think some of that pressure is now exerting itself on NVIDIA's potential upside. And that is, again, like you almost have to pay attention to this stuff on a daily basis because of how quickly the narratives around these stocks are shifting.
Yep. So let's talk about the world quickly. So the chart on top is from 2014 to 2025, and it's the relative performance of the USA versus emerging world, and ACWI ex-US. The chart on the bottom is this year, and I think the punchline here is after a decade-long run where U.S. stocks were leading the charge, and by a meaningful margin, things have reversed this year. And obviously there's some messages in here for advisors about portfolio allocation and global markets and how you allocate capital. But Josh, what can you tell us about the past and anything about the future with regards to emerging or international markets?
So I'll start by saying something that I think every financial advisor who's joined us today would agree, which is that for most of the last, let's say, 15 years since the end of the financial crisis, advisors have been forced to apologize for underperformance of these regions. It just, they've had some decent years. I don't know if you remember 2017 when the big theme of that year was global synchronized growth. You've had some like decent years for the China theme or Chinese internet stocks, but like there's been no follow through, and these global markets have just rallied, fallen, and in the meanwhile, the S&P just keeps chugging along, averaging like 13, 14% a year every year. And then the down years are not bad enough to negate that. And the down years have been followed by positive 30% years. And it's just like you look at the S&P and you say to yourself, what am I doing owning any of this other stuff? What is the point of it? It never goes up. And every year it's a new excuse. It's elections, it's interest rates, it's the dollar, oil prices. Like people got to the point, I think by the end of last year, where it was just like, forget it. I'm done. I don't want to own any of this. And of course, that set the stage for massive outperformance. You look at some of I know you're showing the regions here, which is great.
Mhm.
Just let me give you some highlights. Individual countries, and there's no rhyme or reason for any of these stories. I mean, you can make up a story, but like Brazil is up 55% this year. Is there any reason to believe that Brazil's stock market is 55% better than it was a year ago? No. Why is Canada up 31%? I thought they were supposed to be the tariff losers. What happened? Nothing happened. China is up 33%. Why? No reason. The UK and Germany up 31%. France is up 28%. These are all country markets that are outperforming the United States. Um, the United States is not only underperforming Europe and emerging, but all developed markets as a group. And if you measure it in foreign currency, international stocks look even better than they do in dollar terms. Um, Now you ask me why? What's going on? I wish I could tell you it's because of rapid earnings growth, but that's actually not the case. In the Eurozone and in China, the main driver of returns this year has actually been multiple expansion, not earnings growth. It's people choosing to allocate more toward those places and taking valuations higher. It's not profits. That's one. The other thing is that in the United States, it's the opposite. Returns year to date are coming from earnings growth. PE is flat since January in the United States. I love this. I love this environment. We've had great earnings growth this year, contrary to what a lot of people thought was possible, myself included. Um, but you're not paying up for it. We've actually had a frozen multiple, which I think is good. It sets up potential upside for next year. Now, having a multiple expansion overseas is great because it's a wake up call that those markets had just been oversold and way too cheap. And now, finally, the advisor who's listening to this right now, Sean, doesn't have to call their clients with a year end review and say, I'm sorry I bought you France. I'm sorry. I'm sorry about the portfolio drag from China, which is the thing that they've had to say every year, almost every year.
Mhm.
So that's cool. I like variation. I like a
Yeah,
good comeback story.
and I like that you mentioned the advisors, the mantra, a well-diversified portfolio means always having to say you're sorry. There's always something in
Hey,
that
Sean,
that's
let me
underperformed.
interrupt you. In the chat, Mark Lamontagne says Canada is up because of materials like gold and banks. He's right. But would anyone have predicted that gold would have the year that it had this year? Would anyone have predicted that all of a sudden the banks in Canada would re-rate? They'd be like, I think what that illustrates is not nobody knows what's going to happen. No, some people probably got that right. Almost nobody can do this country by country, year by year on a reliable basis. If you could, we would all have heard of you because you would have $1 trillion under management, but you can't, and I can't, and Sean can't. So, this is the idea behind diversification. In a perfect world, we would only buy the things that are about to go up,
Yep.
but that's not the reality.
So we've talked about ethereal things like AI and regions and themes and Mag 7. Let's talk about a tangible thing, the ag. This slide depicts the fact that since January of 2017, eggs are up 70%. The red is during the Trump administration, the blue is during the Biden administration. And while the CPI for food is up 38%, eggs are up 70%. First, Josh, why is the egg our rally good? And what can you tell us about inflation?
I think the egg became symbolic of the larger issue of inflation because it's so universal. Every culture cooks every region, every level of the income spectrum gets their breakfast protein from the egg. Like it's just like it's a really easy to understand metric. Everybody buys eggs on a regular basis. It's not the type of purchase you make once a month. It's probably more like once a week. You buy a dozen eggs. So I think there's a lot of reasons that it became sort of the rallying point for this debate. Um, as to the chart, it's really interesting. I'm not sure how to trade it. I'm not sure what to do with it. And
Yeah.
I don't want to get into Trump versus Biden stuff.
Mm-hmm.
I think as a society we should be ignoring all of that kind of thing as to the extent that we can. I think what's true to say is that neither Trump nor Biden were perfect in Trump's first term or Biden's term as it relates to inflation. I think there were a lot of things that were done on the stimulus front that were well intentioned, and maybe we did too much of those things or they went awry in some way. And I don't think the history books are gonna talk about either one of these guys as having been like a great force for inflation reduction. And we'll leave it there.
Yep. So rate cuts. We 2025 was a turning point as we began to see the easing of rates. The market persists, the market grows. Either way, I think it's something we all struggle with, which is uh, why do we pay so much attention to something when it never seems to have a real impact on things going up and up?
I think what's happening with the rate debate right now is it's become completely politicized. I think it's pretty clear that Donald Trump will put a person into the seat this May who is virtually guaranteed to lower rates almost no matter what the inflation data says at that time. You might like that, you might not like that. I don't know what to tell you. I don't know that there's anything that our commentary will do to influence that. It's one of those things where the market has decided this is what's going to happen. In the rate debate itself on TV each day, basically we're talking past each other. If you're hawkish on rates, then you're looking at GDP and you're looking at the stock market and you're saying, why on earth are we cutting rates with 3% GDP growth and a stock market at record highs? If you're dovish on rates, then you're not looking at either of those things. And instead, you're focused on the labor market. And you're saying, why on earth are we going to let this get worse? We already know what happens when initial claims start to inflect higher and heavy trucks and credit card past due credit card bills. Like we already understand that historically when all of those things start to tick up off the bottom, we should be in an early warning stance, and we should be easing policy to cushion the blow that's coming. And so those are the two sides, and they're not even looking at the same data. They're deliberately ignoring the data that the other side is looking at. So, and the debate almost doesn't matter because again, the president of the United States, through his executive power, will be deciding who is the next Fed chair, and he has publicly stated the next Fed chair has to be someone who is guaranteed to cut rates immediately by a lot, in his words. So cry about it. put on a lot of black eye makeup, start a band. I don't know what to tell you. This is what's going to happen.
Yeah, well, we may have to do all of those things. So, hey, Mark brought up to us in the chat earlier, and you talked to it a little bit about gold, and he was talking about gold in Canada. But with the expanding liquidity and the weakening dollar, there's a flight towards tangible assets, and gold is obviously up 60%. What can you tell us about tangible assets versus stocks?
Well, let's start with the dollar. If you're bullish on stocks, the last thing you want is a furious recovery in the dollar. That's how bull markets end. That's how corrections start. Um, Go back and look at a chart of the dollar versus, a bull market that's somewhat aged. And typically, what you'll see is there's a relationship there. And there are people that will argue causation versus correlation, or they'll say, which is the chicken, which is the egg, is it the dollar ripping that causes stocks to sell off, or are stocks selling off, thereby creating increased demand for dollars? And you can have fun with that tautology and debate people all day long. But I would say if you're worried about something taking place, that's a pretty obvious place to keep your eyeballs on. The dollar has been weak all year. And so that has benefited gold. Obviously, it's benefited international stocks, which we've talked about, and it's helped the US stock market. And it's also obviously helped earnings. One of the things that we have an S&P 500 with a lot of company components where a lower dollar helps them sell their goods overseas. So there's a lot of beneficial aspects to a weaker or falling dollar. No politician will say that. Politicians always say we believe in a strong dollar, whatever that
Hmm.
means. But that's the reality of where we are. I was very surprised by the performance in gold this year. Gold has done way better than Bitcoin. Gold has really come out of nowhere to be one of the best stories of the year when you look like asset class by asset class, certainly among the best commodities. I think the key thing to keep in mind is gold has regimes. These are long, multi-year, multi-decade in some case periods in which it trends in one direction or the other. And they're super powerful if you're on the right side of those regimes. But the thing is, they come and go without warning. From 1971 to 1979, gold was up 1,300%, which basically annualizes at 34% per year. That's insane performance for any investable asset. But then from 1980 to 2023, gold was only up 3.2% per year. Stocks did 12. Bonds did 6.5%. Cash did 4%. So I don't know if you heard me clearly. I'll say it again. Gold underperformed literally cash uh, by by uh, by a 4% cash, 3.2% gold. So it's not that gold is good, gold is bad, gold belongs in a portfolio, doesn't belong in a portfolio. I would just advise you, if you're somebody that's saying, I want gold in my portfolio, just understand we are in a bull regime. And that might be true that you want it as a part of your portfolio, but that regime will end. It might not end for 40 years. It might end tomorrow. So I think that anytime you're dealing with commodities, all you have to go by is supply and demand, buyers and sellers. There is no fundamentals. So people in gold, they talk about proved reserves, they talk about some fundamental things, the cost of mining gold, and they try to come up with like a fundamental reason for its current price. The reality is it's either in a bull market or a bear market. It's in an up regime or a down regime. That'll never change. And I think it's important to just be aware of the fact that right now we're in an up regime. It's a lot of fun for the people who are long.
All right. Another big story this year was tariffs. On uh, Liberation Day, early April of this year, tariffs took effect and saw a very quick drop by a little bit north of 20%, but then a very, very quick recovery, second fastest recovery from a bear market in history. Um, so tariffs, a lot of volatility, et cetera, but what does this tell us about the relationship between the markets and a whole bunch of macroeconomic thing and how they do or don't correlate with each other? Does the market
Yeah,
care?
this was a real chart wrecker when this happened because coming out of the election, people were super bullish. Even the people who hate Trump, which I guess is, I don't know, 40, 50% of the country, they acknowledged the fact that his policies, as they had been stated up until Liberation Day, were going to be supportive of earnings growth, stock market, real estate, the spending of rich people. Like people were fired up. I think we had a cultural pendulum swing where just all of a sudden people that you would never have expected to vote Republican just basically came out and said, you know what? I'm voting for Trump. Uh, I don't agree with everything that he says, and I don't like the way he talks about certain things. But in the end, I think he's going to be good for my employment, my business, my industry. So he captured that feeling, and a lot of independents went his way, and he won in a lot of places in the country that people didn't think he would, because people really wanted to get back to business. They didn't want to be in the politically correct, cancel culture, police language, close schools for every made up holiday under the sun. Like we had this massive cultural swing. Young people, it was really crazy. And so he had the markets on his side. And it really felt like that was the zeitgeist. And then he did the craziest thing. Like he came out in March, late February, March, and started speaking very aggressively about like throwing tariffs at different countries, different products, really like numbers that people had never heard before. The market got shaky. And then he did this ceremony in the Rose Garden with like the big styrofoam board with all the insane numbers, 100% tariffs, 200%. And that really did shock the market. And it's getting harder and harder for Trump to shock the market. But like that really did scare people. They thought it would wipe out a year's worth of S&P 500 profits. They thought it would take whole industries globally and throw them into disarray. They thought it would lead to like insane shortages of raw materials, finished goods, and just everything went haywire. And then like a week later, or 3 days later, whatever it is, he's like, "Nah, don't go by those numbers. That's not really what we're gonna do." And then that sowed the seeds of a recovery. People started to realize that he was back to just saying things for shock value. And so we did end up with tariffs, and tariffs did have an impact. But what ended up happening is we relearned a lesson we've learned so many times, which is that executives in the S&P 500 are really good at improvising and finding solutions and continuing to come up with new levers to pull to grow earnings. They're really good at passing on costs to customers in ways that are either obvious or not obvious. And I'll give you a quick example. There's a concept called sneakflation. Let's say a company like Target. I don't know how many SKUs they have in their stores. Let's say it's 1 million SKUs. If there's very high inflation on one particular thing that they sell, they don't necessarily have to jack the price of that item up to offset the cost of that inflation. They could jack it up a little bit and then jack up the prices on 100 other items and spread out the pain that they're feeling across 100 different things that they're selling instead of one. And to the consumer, they're paying a few pennies more on that one item. And Target or any other company is hiding that pain by raising the price a little bit on everything else. Sneakflation is part of the answer for how Amazon, Target, Walmart survived, Costco survived the tariffs. It's It's a thing that
Hmm.
not a lot of people were talking about going into it, but became apparent to the sell side who cover these companies. Like, how are they doing this?
Hmm.
Oh, they're sneaking the inflation in where you're not looking for it. So, companies, look, when you think about the S&P 500, this is like a universal lesson for everybody listening to just never forget this. The Fortune 500 or the S&P 500, whichever, whatever you want to look at, these are not like the small business down the street from you. These companies are the best in the world at what they do. Every one of them is the Michael Jordan of its industry. Every one of them. Even when the stock price goes down a lot, those companies are still probably doing better than any company business in your town, local business in your town. It's 500 Michael Jordans. So if you thought that these tariffs were going to knock the S&P 500 out from making money this year, it was the wrong bet. The right
Hmm.
bet, and I wish I had been more bullish. In hindsight, of course, I'm saying this with the benefit of 7 months later, but like the right bet is usually these companies are going to figure it out. And that is the story of 2025. They did.
Yep. And the other maybe big lesson in here for investing is volatility exists. And you would have been real sad if you had liquidated or dramatically decreased your position in the S&P 500 in April, only to have missed the run up and realize if you draw a straight line through this, the market persists, and you got to stick to your plan through volatility. But Josh, this is a
It's
that was.
very hard. It's very hard. And, it's not just the sell decision. It's the when do you buy back decision that I find people struggle with the most because there's no obvious answer. It's not like on April 27th, there was like there was some clarity that there would be no impact whatsoever to earnings. Like people might have said this sell-off is overdone. However, we still don't know the full effect of these tariffs, and it's important to be cautious and blah blah blah. And all of that is true.
Mm-hmm.
But the market, the price recovery led the sentiment recovery, and it's a very difficult game to try to
Mm-hmm.
time markets.
Yeah. I'm still thinking about eggs being up 70%, and my smart retailer, they probably could have been up 300%, but my retailer raised the price of my Pop Tarts.
Orange
Uh,
juice. Yeah, yeah.
Orange juice. It was orange juice. All right. So I have three quick slides here about another theme, which was Washington gridlock and government shutdowns. So 2013, there was a shutdown for 16 days. Uh, the market went up. 2018, there was a shutdown for 35 days. The market went up. This year, a 43-day shutdown, the longest in history, and the market went up. What's this tell us, Josh? Is this reinforcing the same theme that a whole bunch of things can create sentiment or concerns or macroeconomic things, but at the end of the day, we do have smart companies, and the market will persist in growing, and companies will adapt.
I think unfortunately these shutdowns victimize government employees more than they really do anything else. And that sucks. And I don't want to dismiss that pain because if you are sitting at home 2, 3, 4 weeks
Mm-hmm.
wondering what you do for a living now that they're telling you not to come to work and they're holding money that they owe you and not paying it out, it's really ugly. And I hate that our system allows it. And both sides, it's not a Republican or a Democrat thing. They both blame each other. I hate that that's how it works. The thing is, though, Sean, it's not a stock market story. Um, on the sell side, analysts will bake in the possibility of earnings misses, but they will see through those on the other side.
Mm-hmm.
And they understand that eventually you can delay something for 2 weeks, 3 weeks, 4 weeks, but if a deal is supposed to close, it will probably close. And the
Mm-hmm.
shutdown can delay, and we don't get sentimental or precious about, seeing government workers being sent home on Wall Street. It's just It's not part of the equation. It's the bottom line that matters to the people making buy and sell decisions on stocks. And the bottom line is a government shutdown does not halt the economy.
All right. This is the swan song, the final one, which is crypto. How should advisors or investors be looking at crypto in the context of their overall portfolios? Has crypto become more accepted, more legitimized in the last 12 months?
Well, it's become more accepted. We've absolutely seen more firms than ever before allocating it to it, probably because it went up so much going into the end of last year. This year it didn't go up. So we'll see if people want to continue allocating to it. It's a belief thing. So you either believe in it or you don't believe in it.
Mhm.
I honestly don't think it's a big topic for wealth management, other than there have been some huge fortunes created by crypto prices. And many of us in the wealth management business are hearing from some of those people that they want to diversify and they want to build traditional portfolios now that they've made all this money. And so it's definitely something that I think you need to be aware of and understand. And I have certainly made it a point to do that over the last 10 years. Um, but I find that wealth management clients really just don't care about what their advisor thinks. If there is somebody that is into crypto, they're not looking for ratification from their financial advisor. They already believe in it. They already probably know more than their advisor. They're very confident in what they think. So it's not like a thing that people are like, can you please advise me on Bitcoin? If they're in Bitcoin, then they believe in it. And
Mhm.
so I don't think it's a big wealth management topic. And then it's about like really like, do you provide access to clients or do you not? So the big thing that changed this year is all the banks changed their tune. They'll allow their advisors to buy the ETFs if they want to allocate to crypto for their clients. That was a big change. Um, now that, but that doesn't mean you have advisors who are like out there recommending it. Some are, some aren't. Very few are, frankly.
Mhm.
Um, and I think it pisses off a lot of clients. And it might be a demographic thing. If you have a client base where like the average age is 50s, 60s, 70s, like they don't want to hear about it. They feel as though it's illegitimate or they missed out on it already or it facilitates human trafficking and drug dealing and they don't like it. Like people don't want to have crypto pushed on them. So I think the enlightened advisor is able to facilitate access to crypto for clients who care about it, is not actively recommending or pushing it on their clients, and is fluent enough in the concepts of, for example, what is the difference between Bitcoin and Ethereum, that they can have an intelligent conversation with a prospective client who has made a lot of money in crypto. But that's really where I think it ends. I'm not one of these people who thinks it's going to be a 10% allocation standard across brokerage firms or RIAs. I just don't see why it would need to be.
Understood. Um, Hey, Josh, we did have a couple questions I wanted to run by you from the chat. First question was thoughts on Cape Shiller and Buffett indicators.
So the Cape Shiller indicator was worthless as an investment signal. I think I think what they're doing is conflating Case Shiller. Case Shiller. All right, let me fix
Yeah,
this. Okay,
the the Cape
Case
versus the Cape
Shiller.
Shiller. Yeah.
Yeah. Well, but it's confusing because Professor Bob Shiller also promulgated the Cape ratio. So this is the so let me fix this. The Case Shiller index is useful in that it's an index that measures housing prices in the 20 largest metropolitan areas in United States. So if you're trying to understand home prices, the Case Shiller is a standard measure that you can glance at and get a sense of what our home price is doing. And I know that's available on YCharts because
Mm-hmm.
that's where we look at it.
Mm-hmm.
The CAPE ratio, which is also championed by Bob Schiller. But that is, in fact, useless. It has no value whatsoever to determining what the next 6 months or a year will bring for the stock market. Um, the CAPE ratio has been in a top 5% level for over all of time for almost all of the last 25 years. So we've been statistically overvalued according to the people that look at that for some people's entire lives who are investing. So there's nothing really there. I have seen I have seen people that I respect and follow, like Meb Faber, use a CAPE ratio to compare the relative cheapness or expensiveness of different country markets. And I find that to be a legitimate use case for it, just because it gives you some perspective on, making like comparisons between different markets, and that's perfectly fine. But saying the Cape ratio is high tells you nothing about what returns will be over the next year. So it should not be used as a gauge of whether or not you want to buy or sell stocks. The Buffett indicator has not been helpful over the last 10 years. It's basically GNP, gross national product, which is a variation on GDP versus the overall market cap of the stock market. Had you been a seller based on an elevated Buffett indicator like that over the last 10 years, you will have missed out on like a double or a triple, depending on whether you're looking at the S&P or the NASDAQ. So that has also kind of gone by the wayside as something of relative importance. The simple fact is public companies are larger than ever in our economy. They're also global. So looking at the GNP of the United States in relation is almost as bad as the chart crime that Sean and I committed earlier with our Nvidia market cap versus Japanese GDP or whatever we had on the
Yeah.
screen. So I don't think that we need to worry about indicators like that being worthwhile signals as investors is what I would conclude.
Awesome. Well, to our audience, a couple quick reminders. First of all, slides will be emailed to you. Please use them as you see fit. If it helps you in a dialogue with your clients or your investment committee or friends and neighbors, please enjoy. I'm confident in saying everybody learned a little bit, because I learned a ton, as I always do when Josh shares his insights with us on everything from crypto to portfolio allocations to Liberation Day to a
Male
whole
pattern baldness.
male pattern baldness, which Josh and I are both going to be investing in going forward. So, Josh, thank you for joining us. Any final words from you?
Merry Christmas, Happy Hanukkah, Happy New Year to all of our Y charters. I love being part of the Y charts community. I appreciate everything Y charts does to make my job easier. And if you are not an active user of Y charts yet, I don't know what you're waiting for. It's a fantastic platform in so many ways. I wish I had more time. I could reel them off. But we at Ritholtz, we are heavy Y charts users and fans.
Thank you, Josh. And for those of you that aren't aware, I hope you are aware, follow Josh and all of his properties and all of the things he and his teammates, including Michael and Ben and others do. It's phenomenal. You'll learn every day. So, Josh, thanks for joining us. Have a great rest of your day. And to everybody, like Josh said, happy holidays.